If we have different individual assets with different expected rate of return and different risk as expressed by different standard deviation of return, then we will get a structure like this with a curved line in the left side, and we call this line efficient frontier. But the question here, why we are getting this efficient frontier and why it's important? If we take any point inside the efficient frontier, like this one, then any point in top of this point, like this one, it's better for the investor because it's associated with higher rate of return compared to the same risk beared by the investor. Or even to the left side because it's the same return but with lower standard deviation or lower risk. Hence, the points in the efficient frontier are always better than any point inside the efficient frontier. But the question still exists, why we are getting such an efficient frontier? There are two explanations for this efficient frontier to exist. First, for points inside the efficient frontier, if they are not interested for investors, then their prices will go down, and then the same asset will have a higher return automatically due to decrease in the price. The second most important point, which is by mixing of assets. Let's say we mix those two different assets. Then, according to their correlation together, we will have any point inside this circle, and most likely those points inside this red circle. Though it's logic to select any point in the efficient frontier rather than a point inside this efficient frontier, but the question here, which point is more efficient or profitable to the investor? If we take the risk-free return point on the return side and we draw a line that's tangent to this efficient frontier, the tangent point here, M, represents the ideal or the best mix for the investor. To the right side of point M, there will be a little higher return, but with a major higher risk. And to the left side of point M, there will be a little lower risk, but with a major lower return. Hence, M is the ideal investment portfolio. Combining risk-free asset with the tangent point in the efficient frontier will result in a point that's even better than the efficient frontier. Depending on the risk appetite of the investor can be risk-averse by buying the risk-free assets and can be a risk-taker by borrowing from the market and increasing his risk by borrowing and buying actual assets.